Hey, what's going on, everybody? So, I'm active on social media from time to time. Whenever I have free time, I like to get on social media and I scroll through, because a lot of times you get your news from social media. A lot of times, social media, they tell and release the news quicker than, news sites, which is kind of understandable in the information age. But one thing that I noticed and have been noticing lately while on social media are these posts by different random people, no one in particular, but especially on Twitter. Like, people are posting and they're saying, oh, well, I'm discouraged because I learned about credit and the higher ways of credit. I'm paraphrasing. I'm not really quoting word for word, but they're basically saying that they feel bad about credit and feel that it's a scam because, they paid off their student loan or their car note or any loan and their credit score dropped. So I noticed this is a problem, and it's a big problem because a lot of people don't understand how credit scoring works. Like, credit scoring is based on your management of debt. It's based on debt management. Now, a lot of people don't want to hear that. It doesn't sound good to a lot of people, because some people are on a debt-free journey. Some people don't want any debt, So the sound of debt to some people sounds horrible. A lot of people will not sacrifice a good credit score, to have debt. They would rather not have any debt, which is understandable. That's totally understandable. The whole notion of owing somebody and owing someone in order to have a good credit score, a lot of people, they don't like that. They don't subscribe to that notion, which is understandable. However, this whole credit thing and credit scoring is basically a big game that you have to strategize with. It's one of the reasons why I titled my book Strategies to Master Credit. The reason why it's titled my book Strategies to Master Credit, because you have to do just that. You have to use strategies in order to get the best out of the credit scoring system, because if not, the credit scoring system is gonna beat you up. That's just what it is. It's gonna jerk you over. That's just how it's set up, because the credit scoring system is based on your management of debt and how well you manage debt. And if you cannot manage debt well, more than likely it's going to show up in your credit score. So let's get back to what I was saying. A lot of people on that post, is multiple posts, by the way. I see this post often. It's like I almost see it, posted by different people at least 2 to 3 times a month. So I'm noticing that it's becoming an issue because a lot of people aren't educated on this subject matter. So I thought I'd make a video about it. But anyways, they say they paid their car note or their student loan off and their credit score, it goes down. It might go down 13, 15 points. It goes down. And they don't understand why their score goes down. So they say it's a scam. But in reality, whether we think it's a scam or not, it's the scoring system. And the credit scoring system, in a short term, is not going anywhere. It is what it is. It's going to be here. So the best option for all of us is to learn how to scheme around it. We honestly have to play the game of the bureaus, the 3 credit bureaus. We have to play their game. And the reason why your score drops when you pay off your account, whether it's a student loan or car note, is because you're closing out an account. When you pay it off, the account no longer exists. So you're paying off that account. So when you pay off an account, you're closing that account on your credit score. And when it comes to accounts, the more you keep open and active, it helps your credit score. So that's the reason why your score drops. It's a great thing that you paid off your account from a moral standpoint. It's good. You got rid of debt, you no longer owe someone. But from a credit scoring point, it's a bad move. So this is what you want to do from a credit scoring point. instead of paying the car note or the loan off, especially if you paid it early, instead of paying it off, what you want to do is you want to pay it down. And you want to pay it down all the way to the point to where the interest is not affecting you majorly. Like, yeah, of course, if you leave it open and you don't pay off the account completely, yes, you're gonna get hit with interest. But the lower the principal amount that you owe is, the less interest you're gonna end up paying. That's just how it works. So what you want to do is you want to pay it down. You want to pay it down enough, only you notice, depending on what your account is and your interest rate is. You want to pay it down enough to the point where you are not affected by major interest. You just pay it down, and that's similar to being debt free. It's not all the way debt free, but you don't have to worry about that loan or that car note into the future. Let's say you decided that you wanted to pay your car note off early. Let's say you had a 5-year loan for your car note, and you got to the point in year 2 where you're basically almost paid it off. You have $500 left on a $15,000 loan. So in 2 years you cover majority of that loan, and you're left with $500. So more than likely your next payment is not going to be due for a couple of years if you decide not to pay it off. So what you can do is you could chop that 500 down a little bit more. That way you won't get hit over the head with interest for months. And when you pay it down, the account still stays open. So not only do you have a good debt to credit ratio and a good debt to income ratio for things such as getting a house or a car or whatever, you're also keeping the account open, which is important because it helps your credit score. Now, if you're at the point where you're not going to need your credit score for anything, like you're not attempting to get no house, you're not attempting to get anything, you're not going to need your credit score for anything in the near future, then hey, go ahead, get rid of your debt, pay off the account, but please expect your score to drop. But if you're in the market for a home in the near future, or maybe a new car that you're gonna finance, or whatever you're gonna do, if you're in the market for anything where it's gonna require you financing, please do not pay the account all the way off. You want to pay it down to where it has no major effect on your finances. Pay it down to the point where it doesn't affect your credit score, and it also doesn't affect you financially. You're not getting beat over the head with a lot of interest, because yeah, you'll pay interest, but like I said, the lower that principal balance is, the less interest you're gonna pay. So that's why your credit score drops, because you close out the account by paying it off. If you want to preserve your credit score, you simply pay your account down. If you don't care about your credit score, then pay it off. Why not be debt free? But if you do care about your credit score and you don't want it to drop, make sure you leave that account open simply by paying the loan down. You don't want to close it out completely. Just pay it down to the point where the money that's left doesn't affect you too hard with interest. And that's all I have to say regarding this matter. Of course, people will view it from a subjective standpoint. Some people would rather be completely debt free with it and get the account wiped out and just not worry about it. And some people want to preserve their credit score because maybe they're trying to get a home or something in the near future. Either way, you take your advice, whichever one works for you, that's what you do. Be sure to like and subscribe. I thank you all for listening and supporting. Thank you.